Are you looking at 2025 as the year you finally take control of your money and start building real wealth, but you're not sure where to begin? Well, you have clicked on the right video. Today I'm breaking down the 4 best investments you can make in 2025, but not the kind where you throw your money into something you barely understand and pray for a miracle. Instead, the kind of investments which can help you secure your financial future, and you don't need to be the wolf of the Wall Street to get started. But before we dive in, here is a bonus investment that costs you absolutely nothing, just a little effort to hit the subscribe button and turn on notifications. Why should you do it? Because every week I share videos on personal finance, self-growth, and practical tips for living a fulfilling life without draining your wallet. Alright, now let's jump into it. Number 1. Paying off high interest debt. Let's be real. Trying to invest while carrying a high interest debt is like running a marathon with a backpack full of bricks. Sure, you might make it, but at what cost? High interest debts, especially credit card debts or personal loans, often come with a mind-boggling interest rates of 15 to 25% annually. That's like watching your money evaporate in slow motion. Meanwhile, your investments might give you a respectable 8 to 10% annual return in the stock market. So do the math and you're still coming out in the red. Now, why do so many people fall into the high interest debt trap? Honestly, it's mostly about appearances. People love to look rich, even if they're broke. Fancy gadgets, trendy clothes, dining out at overpriced restaurants, it's all about impressing others. And when there is an emergency, they have no savings, so they swipe that trusty card, digging an even deeper hole. Here's the deal. Paying off high interest debt isn't just a financial win, it's a guaranteed tax-free return. Every dollar you don't pay in interest is a dollar saved, and that's the money that stays in your pocket. Plus, it's like getting an instant raise because now you have more room in your budget for savings, investments, or even guilt-free splurging. What counts as high interest? For me, anything over 6% qualifies as high interest debt. Mortgages are exceptions because that's a debt on an asset, but again, that's a topic for another day. This is more of a personal preference, but for majority of the population, anything over 8% is a high interest debt, especially if it was used for a liability or depreciating asset. The point is, paying off high interest debt first is the smartest investment you can make for your future. Trust me, nothing beats the peace of mind that comes with being debt-free. Number 2, investing in broad market index funds. This is probably the simplest and smartest way to grow your wealth, by investing in broad market index fund. As the name suggests, these are funds that track the performance of a very broad stock market index, which means a group that includes many stocks. This gives you exposure to a diverse range of companies with just one investment. Think of it as ordering a sampler platter at a restaurant. You get a little bit of everything without having to pick individual stocks. For example, you can invest in an S&P 500 index fund ETF like SPY or VOO. These funds track the top 500 largest companies in the US, from tech giants like Apple and Microsoft to retail powerhouse like Amazon and Walmart. If you want even broader exposure, you can go for a total stock market index fund ETF like VTI. These funds include every publicly listed company in the stock market, from massive corporations to smaller up-and-coming businesses. So why are these index funds such a great choice? Number 1 is diversification. Your money isn't tied to the success of 1 or 2 companies. It's spread across multiple sectors and hundreds or even thousands of businesses. Larger and more established companies make up a bigger portion of the portfolio, which helps reduce risk and create a balanced investment strategy. Number 2 is low fees. Since these funds don't require active fund managers to manage investors' money, their management fees or expense ratio is very cheap, which makes a huge difference over the long term. Number 3 is minimal effort. You don't need to study stock charts or stress over market trends. Just invest consistently and let compound interest do its thing. Historically, these funds have delivered an average return of around 10% annually or 7% after adjusting for inflation. While that might not make you rich overnight, it's a steady, reliable way to grow your wealth over the long term. I've already made a detailed video explaining the index funds and the ETFs, so I'll link it here in the corner and also in the description below for you to check out. And hey, if you're enjoying this video so far, don't forget to give it a like and share it with someone who could use a little financial wisdom in their life. Now, let's move on to the next one. Number 3 is buying a used car. Yes, let's talk about cars. Specifically, why buying a brand new car is one of the worst financial decisions you can make, unless you enjoy burning money. Here's the ugly truth. A new car loses value faster than most people lose their New Year's resolution. A shiny $50,000 car, give it 5 years and it's worth about $16,000. Ouch. And let's not forget the cherry on the top, the interest on your car loan. Over the 5-year loan term, you might pay $58,000 for the same car, which is now worth less than half of its original price. So what's the smarter move? Buy a used car that's 3 to 5 years old. By then, most of the depreciation has already happened and you're getting the same functionality for a fraction of the price. Bonus points, since it's gonna cost way less than a new car, you can probably pay in cash because taking a loan on depreciating asset is not a very smart move. However, if you still need to finance it, pay at least 25% down, finance it for no more than 3 to 4 years, and your monthly car payment shouldn't be over 10% of your income, because if it is, then you're buying a car which you can't afford. So the point is, a used car is practical, cost-effective, and doesn't come with the financial regret of watching its value nosedive. Last but definitely not the least, invest in yourself, because the most underrated investment of all is you. If you're earning close to minimum wage or just barely above it, it's time for a reality check. The issue isn't that you're not working hard, it's that you lack the skills or knowledge needed for higher paying opportunities. The solution? Invest in certifications, licenses, or courses that make you stand out in the job market. For example, if you're in IT, getting certified in cloud computing or data analytics can open doors to 6-figure jobs. If you're in another field, figure out what skills are in demand and go after them. The great thing about investing in yourself is that the returns are exponential. A one-time expense on a course or certification can lead to a lifetime of higher earnings, better opportunities, and let's face it, less stress about money. It's the gift that keeps on giving. But remember, financial freedom isn't just about earning a lot, it's about making smart choices with what you have. And if you're stuck in a minimum wage job, check out this video where I break down the step-by-step process of how to go from earning minimum wage job to hitting 6 figures. Until next time, keep growing and keep hustling.